Well, I'm showing 9 a.m. Central Time, so we'll go ahead and kick off the aftermath. Thank you for those that jumped on this morning. It's kind of an odd day. It is that really odd day of the year where the government offices are closed, the banks are closed, but the markets are open. And I remember several years back, this was the day we seemed to always take a lot of the LDPs 20 years ago. The markets typically traded higher on Columbus Day, and the FSA offices were closed, so the LDP rates didn't change. And so it seemed like we would either flood their drop box or flood the fax machine or whatever with taking LDPs today. So again, kind of an oddity. I think I said on my call this morning that we would get export numbers and crop progress numbers today. That was a mistake. We won't get any government reports today. Those will be postponed until tomorrow. So a lot of kind of weird stuff happens, I guess, on Columbus Day. So kick it off. I do want to show this one chart. I usually show these some strange chart at the beginning, and this one I do have the label on it up at the top left, but it's the Hang Seng Index, the Chinese stock exchange. And you can see what's happened to the Chinese stock market. It had really floundered for several months, and now all of a sudden here in late September had this huge rally. And what caused that rally? Well, that was driven by stimulus. The Chinese government, similar to some things that the United States government did a couple of 3 years ago, announced that they're going to have some big stimulus package. They don't know exactly; they haven't really said what that details. But nonetheless, we saw this huge rally in the Chinese stock market. But here over the last week or so, that has gone back down again, as you know, a lot of things do. We had so much anticipation, and nothing has really happened yet at this point. So I just wanted to show this at the beginning, and it may, it may come into play for uh, commodity markets like soybeans, like cotton, things that we rely on China with. And so something to be cognizant about here as we move forward. So digging into the aftermath, what are the biggest market factors right now? Well, these are my big four at the moment. Certainly the large U.S. stock situation is at play. The government reinforced that again on Friday, that we're going to have a lot of everything again this year. The funds have covered their shorts. Holy cow. You go back 6 months ago, we were talking about the funds being record short all of these markets. That has totally flipped. These people have bought back just about everything they were short. So why hasn't the market rallied more? Well, we'll dig into that here in a minute. South American prospects are changing. A month ago, 3 weeks ago, we were hot, dry in Brazil, and things were looking a little bit tepid, but that has changed a little bit. We'll talk about that here in a minute. And then lastly, the macro influences, the dollar index, the oil market, some of these things, and that's driven by what's going on in the Middle East, in Ukraine. And so all of these things outside of ag that do have an impact on what happens ultimately in commodities and in the commodity sector. So I'm going to start and go backwards with those four. We look at the dollar right now. The dollar's on a huge run. In fact, this morning it had traded up over 103 points, which is the first time since June. And so the dollar's on a big move, and that's not a good thing typically for us in the ag world, because we rely on export business to help boost our markets. Strong dollar doesn't help that. And so that's something that we're concerned about. I think the market's concerned about it here today. Um, I thought this was interesting. Susan Stroud put this out recently, talking about the dollar versus commodities. And, in the old days, the dollar and commodities, at least in our ag commodities, kind of worked the opposite direction. But in the recent couple of years, you've seen those start to kind of move together a little bit. So you would hope that, given that we would see these commodity markets firm up a little bit with this dollar, but hasn't necessarily been the case this week. The oil market, one of the big movers in commodities. Of course, the driver in this rally in oil has been the war in the Middle East, the uptick between between Israel and Iran, and its proxies certainly has been the driver for this rally. We've rallied 20% off the low, and things have backed off a little bit at the end of the week, but still, it's been a huge move in the oil market. Now, historically, that's been a good thing for the ag markets because we tend to see markets like corn follow the oil market, and to some extent it has from late September. Now, the last week or so, however, you've seen the oil market back off, and corn has kind of done the same thing. And I guess that's what this shows right here. You see that correlation here between oil and corn futures, and it's been pretty close over the last many years. And so something to keep an eye on there. South America mentioned their situation. They've been a little slow getting the crop in the ground this year. A year ago, they were about 10% done as of last Monday. This year, only running about 4.5% completed on the first crop on the soybeans. And why is that? Well, it's been hot and dry down there. And if you look at the last 90 days, it's pretty typical of their winter going into spring. They don't get a lot of rain, but they've had above normal precipitation as well. So they've certainly had a lot of evaporation. But most of Brazil has been well below normal on precipitation over the last 90 days. And so it's become imperative that they get some water, that we see that monsoonal shift that we typically see come their spring. And so look at the last 7 days, it started to happen a little bit. You've started to see some precipitation slide from south up into the northern central parts of the country. And as you look forward even further over the next 7 days, the European model shows some significant rain. This is Mato Grosso right here in the middle of the country. And so this is the biggest producing state in Brazil. And then you work south and east is where a lot of the beans are grown. And so they're expected to get some very beneficial rains over the next 7 days. And if you look out over the weeks 1 and 2, you can see that's expected to continue. And so this is part of the reason I think you saw the bean market trade lower last week, and why we're struggling maybe to get on the higher side here this week. So we'll continue to watch South America very closely here in the weeks and months ahead. The funds, what are they doing in ag? Well, if you not just look at corn, beans, and wheat, but you throw in meal and oil, the funds are now long these ag markets combined. The first time we've been long, if you go back and look at the gold, about September last year was the last time that these funds were actually long these commodity markets, and so these ag markets. And so they've been on a huge buying run. 7 straight weeks of buying has taken their net position from a record short combined up to a nearby long position now. And we'll look at each of the crops here in just a few minutes. But the driver for that, certainly one of them has been the drought in South America. One has been the crude oil market. So some of those have given a boost. Some of it, I think, is seasonality. I think the funds typically think that we make our lows, maybe this time of the year. And so maybe there's not a lot of downside price risk at this point. So they've bought back their short positions. Now, again, why hasn't the market rallied more? Because we've had a record amount of corn on hand in the farmer's hands as of June 1st. And so despite this big buying run, you saw heavy producer liquidation of corn, soybeans, wheat here at the end of the summer that offset this big move. And so that's really what's been happening in the markets. Now, the number one thing we mentioned was stocks. And if you look back to last Friday, USDA confirmed once again that we're going to have big crops this year, that we're harvesting a big crop. 183.8 was the U.S. yield, 15.203 U.S. corn production, both of those record numbers. That yield number was up 0.2 of a bushel. The trade thought we were going to drop it a couple of tenths of a bushel. So bigger production. Soybean production yield came in just about as expected in the report on Friday. Ending stocks, corn, just a tick under 2 billion bushels. That is down from last month, but it is higher than what the trade expected to see. If you remember back on September 30th, we got a bullish stocks report that told us that last year's or old crop demand had been stronger than what we had thought. And USDA reduced the old crop stock number. So that carried through into the new crop. However, the bigger crop size meant that we had a few more bushels than what the trade was expecting. Beans unchanged at 550 million bushels from last month, still bearish in my opinion. Wheat, 812 million bushels, down a little bit from last month, but really nothing there to trade on as well. And I'll show you the maps here in a minute. but these are from Karen Braun with Reuters. Put out the state numbers on yields for corn and soybeans compared to a month ago. You can see again the red were the drops. Indiana had the biggest drop from last month in corn yield, as well as in soybeans, one of the bigger drops. Ohio down 5.5%. Pennsylvania down 10.9%. So not very good closing weather in the Eastern Belt, but nonetheless, some pretty good numbers. So let's start out looking at soybeans. Soybeans have, in my mind, I continue to say that they're the most bearish balance sheet of all of the crops right now. Unless we get a weather situation in South America, I just don't think that this bean market's got a whole lot of run to it. Now, can we get some surprises? Yes. Can China come in and buy more beans than expected? Hopefully that happens. But in the meantime, beans, we're still trading a bearish balance sheet, and that's partly because of the U.S. numbers. If you look at U.S. yield at 53.1 bushel per acre, new record high, back above trend for the first time in a couple of years. Look at production at 4.58 billion bushels, also a new record this year. Part of the reason for the record, too, was bigger acres getting planted to soybeans here this past year. And again, we look at the maps here. I showed you the numbers a minute ago, but if you look at the map, red numbers went down from last month. Blue numbers went up. We do have a few record bean yields. Illinois, Iowa, both showing records. Missouri, a record. Arkansas, Mississippi, New York State, Texas. Don't grow a lot of beans in Texas, but we do have a few record states. But overall, a U.S. record yield of 53.1 bushels. And, the big deal this year, as it was a year ago as well, we don't have a lot of states that had records, but we don't have many states that had bad crops this year. Yes, we did hurt the crop because of the hurricanes, the hurricane coming up through Georgia. Yes, the Minnesota crop was down this year because of some early planting issues, but overall, it looks like we're going to have some pretty good bean crop numbers. And if you look at this, this is again an interesting chart that USDA puts out, showing the NASA satellite imagery, showing where the yields are good and bad and whatever around the country. So I thought it was interesting to share. Where was that number on Friday? Right in the middle of trade estimates. So not a surprise. So the bean report, I would call it neutral as far as the report itself goes. And if you look at the balance sheet numbers, USDA made very few changes. They did lower that yield 1/10 of a bushel, took production down just slightly, took residual usage down to offset that. So ending stocks stayed at 550 million bushels. That's the biggest we've been in over 5 years. Average farm price still estimated at 1080. USDA did lower last year's average farm price to 1240 in the report on Friday. But again, this number is, in my opinion, still bearish. And this is a chart I've showed going back to last winter, but we're in that pattern of growth in stocks and decline in price, very similar to what we did a decade ago. And when we came off of the very high prices back in 2012, we incented a lot of growth in acres, both in the U.S. and in South America. And for 2 to 3 years, you saw increase in U.S. stocks, world stocks increased as well, and prices continued to drop. Ultimately, we had this huge stock situation following huge crops in both the Southern Hemisphere and the United States, and prices went back down into the mid-8s. Fast forward, kind of following a similar trend right now. We've got stocks to usage in the United States rising, and we've had prices continue to come down. So what's going to get us out of that? Well, it would have to be export business. Our domestic usage is rising. Don't get me wrong. And if I look back at the numbers, domestic crush, particularly for the soybean oil, is expected to be a record 2.425 billion bushels. That's half of it. The other half is this export number. USDA saying we're going to increase exports 150 million bushels. Well, right now we're not off to the start that would say that we're going to get there. Now bean sales have picked up a little bit, but we're still kind of hovering around last year's type numbers. And so to say we're going to get back up closer to where we were 2 years ago, something's going to have to change quickly. And at the moment, we're still forecasting huge crops in the Southern Hemisphere. And if you look at the big three, you look at the United States in red, Argentina in blue, Brazil in green. If they raise the crop that USDA and others are forecasting, holy cow, we're looking at another world record in production this coming year. If that happens, it'll be the third straight year we've had a record production number. So will that happen? That's why South American weather continues to be, I think, the biggest factor for the bean market going forward. But if you look at values, Darren Fessler shared this morning on Twitter or on X. You can see that Brazilian beans right now delivered to China are priced higher than U.S. beans in purple. But once you get out to month 3, which is what, January or December, now that starts to change. You get into January, Brazilian beans are going to be a lot cheaper and going to continue to be. So if the U.S. is going to really make a difference, make a dent in the export number, it's got to be here in the next 60, 90 days. Because once you get out into the South American harvest, when South American stocks are available, typically they become the cheaper market. And so we're going to really need South America to be, or China to be buying. And Pedro Dejneka sent this out over the weekend. And I thought I like his take. He's from Brazil. He lives in the United States now, but he's got a pretty good take on what's going on in South America as well as Brazil. And he thinks that our carryout in the United States is probably going to be 600 to 700 million bushels, given the amount of competition that's coming out of South America. Right now, USDA's got us at 550. So if these export numbers don't start to kick up, again, holy cow, if that Brazilian crop gets to 160 plus million tons, it's going to be tough to get to see our ending stocks stay at 550 billion bushels, which would be bearish to the soybean market. So if you look at the world numbers, the U.S. number, stocks to usage, I showed you a minute ago, still at 12.5%. At the world level right now, we would be at 23% if the South American crop is as big as what everybody thinks it's going to be. So we still got a long way to go. You've still got the entire growing season in front of us. Planting down there, probably pushing 10% as of today. We'll get some numbers, I think, this afternoon from Ag Rural, show us where they're at. But with the rain starting to pick up a little bit down there, that seems to be the game changer for the market. Now, funds have bought back their short, again, partly because of the dry weather down there that we had seen, but the funds have bought back and they've covered. They're only short about 20,000 contracts as of last Tuesday night's close. That's the smallest that short has been in a long, long time. So we'll see where they decide to go from here. Is there a reason the funds want to buy at this point in time? I would think that it would have to be South American weather or extra Chinese demand would be the driver in that. Otherwise, I don't see that they would want to necessarily go long the soybean market. You see what they're doing in oil and meal, and these have really been the driver in buying back the beans, that we've seen good oil demand. Funds are long about 30,000 contracts of oil. They've been long meal, nearly 100,000 contracts. So the products have been the driver in the rally that we'd seen in beans. Can they sustain it at this point? That, again, remains the big question. So here's November soybeans. We're in an important window right now for many parts of the country. We're setting the insurance prices, the harvest prices, and we'll do that through the rest of this month. So we're nearly halfway through. And I've marked that on here with this green line off to the right, where we're kind of running right now. And we'll talk about that more here in a few minutes. The revenue protection price is down 11% from where we were last year, 11.55. Right now, the margin protection price would be down 20%. So high-level coverages, 95s on both ECO as well as margin protection, probably will trigger some payments, especially the margin protection this year because of how high we started in the 12.95 window last year. So we'll talk about that more as we finish up. But where's the chart at? Again, this rally we had seen from mid-August, this was really driven by the funds covering their short positions for 7 or 8 straight weeks. You saw some pretty good buying, and some of that because of weather in the Southern Hemisphere. And then this thing just kind of died. What has happened since then? I think you haven't seen the buying in the products that you had seen before in soybean meal and oil. I think the weather has changed in South America, where the forecast is showing more rain opportunities here as we move forward, and that's just taken the bloom. Plus, you've had farmers selling. Here we are in the beginning of October, and if farmers needed cash, did they want to sell corn? Do they want to sell soybeans? And with over a dollar rally in the soybean market, I think it's made it pretty attractive as as a place to sell and get some cash. And so I think that that's been a big driver in this thing as well. So we stopped short of the 100-day moving average, which is down to 1060 right now. Here today, we've dropped back under the 9, the 20, the 50-day moving average. We dropped back below this uptrend line last week. You can see here in the red, I've marked where we had November beans that were in the hot zone, back in March, back in May. And then here just 10 days ago, you had beans in the hot zone. If you follow the market report email every day, I label the hots and the nots, and beans had reached that hot zone where we had the RSI pushing up into the upper 60s. The stochastics at the bottom had pushed up into the 80s. This market was ripe for a correction. And so we were suggesting, by putting this in the hot zone, that it's a good opportunity to take advantage of. And so hopefully we got, a lot of guys got some beans priced at some pretty good levels here. Markets today probably pushing down into the not zone already. And I had beans on Friday in the not zone where you've got the RSI under 40, stochastics are down into the 8 and 22. So this market's probably reaching into oversold status at the moment, right around this $10 level. Plus you had multiple lows back in September, just underneath the $10 mark. We'll see if that can hold as pretty good support. And it looks like at the moment that it might be. I did see the market was down a little bit early this morning, but we had come back right before the meeting and we were down maybe a penny. So we'll see if this area can hold around the $10 level. And if it does, maybe give us another nudge back higher. The 9-day moving average at 10 1/4 today would be the first target I think I would have as far as pricing some old crop or some harvested soybeans that you're taking out of the field right now. Long term, certainly that 955 sticks out. Can we go back down there before expiration of the November contract in about a month? I guess I can't rule it out. If harvest continues to plug along and we continue to see a lot of farmers selling out of the field, if guys are making decisions on whether to hold corn or beans, certainly right now, I think a lot of people are wanting to hold corn, and I continue to think that we'll see some beans being sold. And this was a neat chart too that showed their inverse relationship of the dollar compared to soybean prices. And so it shouldn't be a shock that we're seeing, the cheap dollar that is driving is a negative impact on bean price as well. Looking ahead to next year, we did get back to $11, and I think that had been a number we talked about a month ago at this on this webinar. That the 100-day moving average, pretty good target. It was up, it's 1085 now. It had been up over $11, and we got back above that for a few days. Again, this was in the hot zone. RSI touched or almost touched 70. Stochastics were well up into the 70s, 80s. This market needed to be rewarded. I think I was talking maybe a small 10% increment, some start to selling for next year. Now we're back in the not zone. So I don't want to be a seller today. Where would I price it again? I think the purple line would be another target of mine, around 1080. You get back up there, not a bad place to start pricing a few beans. Why do I want to do that? Well, you're going to have, it looks like, potentially a huge crop coming out of South America next year. That's going to come out next spring. They're going to be selling beans all the way through the summer into next fall. If that's the case, they'll be competing with us next fall for export business. What are bean acres in the United States going to do this coming year? I don't think they're going down. I don't know if they're going to go up a lot, but we had a big increase this past year, and I don't see us planting less beans with input costs in corn and maybe cotton as high as they are. I tend to think we're probably going to continue to plant a lot of soybeans, especially if we remain above $10. And so I don't think it's a bad place to be rewarding the market. Flipping to corn, the yield again at 183.8, easily a new record high. Almost 6 bushel higher, or 6 bushel higher than the previous record last year. Pretty impressive. And if you look at the state numbers, again, the red ones went down, blue ones went up. We've got several states with record numbers this year. Illinois at 222, Iowa 214, Nebraska, South Dakota, New York State, all with records. Louisiana with a record 189. Overall, again, a record at 183.8. But again, I would point out that we didn't have any states that had bad yields this year. We had some that were, that were marginal. We had some that were not much better than normal, but we didn't have any knockdown, drag out bad numbers through much of the key producing area of the country. And looking at the satellite map, again, mapping yields, the heart, from basically central Indiana west through much of middle part of Illinois and then up into central and western Iowa, eastern Nebraska, basically where we've had our best yields again this year. Production wise, it's not quite a record because we did have lower acres this year, but 15.2 billion after 15.3. Holy cow, back-to-back record corn yields and record corn crops is going to add stocks. And this number yesterday or Friday was just at the high end of trade expectations. And again, probably a negative for the market. So look at the report numbers and the balance sheet on Friday. First, let's look back at last year's, because back on September 30th, we had gotten the September 1 stocks report, which told us that last year, marketing year, we ended up with 1.76 billion bushels of corn. That was lower than what USDA had been projecting the previous month. And how did we get down there? USDA raised the feed number, raised the ethanol number for last year to get us down to 1760. And that was the lowest that stock number had been all year. So we'd been talking 2+ billion bushels ending stocks. Demand was better than what we expected. And so that's tremendous, that low prices are maybe the cure for low prices. We were seeing some of that take place. Average farm price, they told us, was down to $4.55. So the 1760 carries into the new crop. You add that on to our little bit bigger production number, we're going to still have close to 17 billion bushels of supply. USDA did raise the export number 25 million bushels, kept ending stocks at 1.999 billion bushels, which is down from a month ago because of the better old crop demand. However, it's still a big number, still the biggest we've been in 5 or 6 years. And average farm price at $4.10. So not very impressive there. So as long as we continue to raise good corn crops, even with better demand, 14.99 billion in demand is the biggest we've been, maybe history. I didn't look back. I think it is the highest we've ever been, but still we're looking at a lot of corn. So stocks starting to grow, continuing to grow here in the United States. At the world level, it's pretty flat. So you've got a lot of smaller producers around the world, but they all add up. And the U.S., even though we're the biggest chunk of that, not having a big impact overall in world stocks to usage. But again, you go back to that heavy farm stock liquidation that we saw this summer. It was pretty impressive that we had, 3.03 billion bushels of corn on farm as of June 1. They had taken that down to 980 million bushels as of September 1. That was in the September stocks report. So we saw this huge liquidation, 2.25 billion bushels of corn, nearly, if not the most we'd ever had during that 3-month summer window. And so while the funds were buying back their short positions in corn, the farmer was selling over 2 billion bushels, and they more than sold what the funds bought back. And that's why we didn't get a more substantive rally. Now here we are in fall. What's weighing on the market today? Basis is widening in every market. Kind of interesting to see these numbers. St. Louis, Western Corn Belt, Eastern Corn Belt, Iowa, Nebraska processor. We're continuing to see widening of the basis. We're pushing 50% done with the U.S. harvest, and it looks like everybody's getting enough corn at this point. So basis is continuing to widen. That's widening those carries. And so that's, I think, part of the reason, too, that we're seeing a lot of selling in beans and farmers wanting to hold corn is because of the carry opportunity. We've talked about that the last couple of months, but certainly big carries. Now, the funds have bought back most of their short, kind of like they did in beans. So again, but that's been offset with the huge farmer old crop selling that we had. So where do the funds go from here? Remains to be seen. Is there a reason they'd want to get long? I think that really comes down to foreign demand, and I think that boils down to China. Does China buy U.S. corn, which they haven't been doing much of over the last couple of years? I don't foresee that being the case today, but I think that that's going to be the driver if we're going to see this market get up and go. So here's where we're at. December corn. Again, I've got the green line on the right marking where the crop insurance average is so far this month versus the revenue price in February. We're down about 9% versus the margin price. We're down 17%. So some of these high level policies will probably trigger some payments, especially the margin protection this year, even if your county yields are pretty good. And I think we're going to see that across the I-states where we're going to have some good county yields, but some of these higher coverages still might trigger some payments. So the one thing I didn't suggest in beans, but I do, these policies do provide you some extra price protection between now and the end of October. However, when that's over with, like a year ago, the policy is it doesn't provide any more protection on price. And so I still like these min-max type programs where you buy a put and sell a call. I think that those types of programs continue to put a floor, take a ceiling, give you some downside price protection, especially if you're putting the crop in the bin. And I still like the March contracts right now for corn. Buy a March put. Maybe I have to go down to $4 or $4.10 today. Maybe sell a $4.50 or $4.60 call. Have a floor at $4.10 or $4. Have a ceiling at $4.50 or $4.60. Worst case scenario, the market rallies to $4.50 and I get stopped out of my position. I end up with a short position at $4.50. And I think all of us would take that today, selling corn at $4.50. By the way, that's a penny above the 200-day moving average on December corn right now. So, can we get above that? I think it'd take some massive bullish scenario to get us to see that. And I don't know what that would be right now. You've got the RSI, you go back 2 weeks ago when the market topped out at 434. You had the RSI at 70. Stochastics had pushed up into the 70s. This market was hot. It was right for a sell-off. We had it in the hot zone for a couple of days, and then things turned down. And as it stands today, we're nudging down closer to the not zone. We'll see if we can have support maybe at the 50-day moving average at 407 3/4. I would tend to think that probably will hold this market for now. I don't see that we've got a ton of farmers selling in corn. It's going to just continue to hammer this market. The exception to that might be is if you start seeing elevators fill up and start telling farmers that we don't have open storage anymore. And I've heard that from some places that basically they're forcing the farmer to have to sell corn if you take it to the elevators. So we'll see what happens here in the last 30% or so of harvest as we go forward. Upside targets, certainly this high at 434 that we had back a week or so ago, the 449, the 200-day moving average, those would be a couple of targets. I'd probably fade those by a few pennies. So maybe 430, 440 be some places I'd want to put some offers in versus the December contract. If you've got grain in storage and on the farm, then, maybe bump those 10, 15 cents for the March contract as far as offers. Looking ahead to next year, pretty similar situation as a lot of the markets. Here at the beginning of October, you had this market in the hot zone for just a day or two, pushed above the 100-day moving average, couldn't hold it, and now we've traded back lower. We're kind of following the 100, the 9, all of these lines kind of trending a little bit lower right now. I don't know that there's a big reason for a sell-off in D's 25 corn, except for the front D's. If D's 24 sells down, 25 is going to get dragged with it. And there's a big carry in this market right now. Still, you've got 414 December 24, 449 out here. You got a 35-cent carry from one year to the next. That's about 3 cents a month. Not great with higher interest charges, but still, if you're looking to take advantage of the carry, a lot of farmers today, if you got grain in the bin, some guys are going to go all the way out maybe to next September, December and hedge this higher price rather than selling March, say at 4 1/4. And so maybe you sell D's 25 at 455, 460 again if we get back up there. And worst case, you hold your old crop to next fall, deliver it right ahead of harvest, set the basis here off the D's 25 contract. Or if you get a rally in the meantime, you sell the old crop and then use this hedge on D's 25 to apply against next year's crop. So there's different ways to skin a cat. But in these big carry markets, the opportunity is there to forward sell these higher prices that we've got out in the deferred contracts. The wheat saw a lot of small tweaks to the balance sheet. We went back and adjusted last year's production numbers, only made a couple million bushel difference. In the new crop. We saw some drops, didn't make a big difference in the big picture. We had an increase in feed demand, but overall ending stocks dropped about 14 million bushels. Prices, government left unchanged. The big story, I think, in wheat is going to be the La Nina, the impact on the hard red winter wheat crop, especially in the southern plains. We are expected to see La Nina peak out here this fall and then start to dissipate as we go into spring. But even along with that, we're seeing some forecasts here this morning for better rain opportunities in the 2-week window right now, and weeks 3 and 4. And so that's been, I think, a negative for the wheat market here over the last couple of days as that forecast has started to shift. Now, this was the forecast back at the end of September, was above normal temps, below normal precipitation. But again, we're starting to see better rainfall forecasts right now out into next week, out into this area here in the southern plains. And that, again, has taken the top off the wheat crop. A lot of focus in wheat is going to be on the world numbers. There's been some talk about the crop being a little smaller in the former Soviet Union. USDA lowered this year's crop a little bit, lowered the EU crop 1 million tons, offset that with a drop in usage. So actually ending stocks at the world level went up 500,000 tons to 257.72. And you can see pretty much a sideways ending stock number, stocks to usage down a little bit this coming year. But that was a little disappointing, I think, to the bulls and the wheat that were hoping maybe we'd see a bigger drop in the Russian crop. Didn't happen here in this report. But the Russian crop has made news lately. This is from a week or 10 days ago or so. Russian weather agencies see worse conditions for the winter wheat. The precipitation March through September in Rostov had been the lowest in recent history. And so that had been the driver for some of this rally and some of the short covering we had seen in the wheat market. But you look overall, U.S. stocks still rising. World numbers continue to decline a little bit. And so if there's a sleeper bull scenario in wheat, it's at the world level. It's probably not in the U.S. level, even if we're dry in Kansas, Oklahoma, et cetera, here for the next several weeks. It's the world level that's going to drive this market if we're going to see much upside. Now, that said, we did have wheat in the hot zone briefly, again, at the beginning of October, as we pushed up, made this double top, it looks like, in the market here with the high we had back in early July. That also stopped at the 200-day moving average. So hindsight's pretty good, but, you go back to the hot zone, and the market was telling us to reward it with a sale up here, and hopefully we were able to price a little bit of wheat. And now here we are back at the 100-day moving averages, just kind of in a sideways pattern, I think, at the moment. RSI at 56, stochastics pretty flat right now. So you can see all of these moving average lines are kind of starting to funnel together. Tells me that the market has, I think, reached its equilibrium level somewhere between 570 and 610. So if you get to the upper end of that range, up around this blue line at 613, probably not a bad place to hedge some old crop wheat. You're down at the bottom of this range, probably don't want to have to be a seller at this point in time. Seasonality in Chicago wheat, I thought was kind of interesting. Here's where we were last week. One of the year or the 5-year seasonality is actually for a little better pricing during this window, but the longer term seasonality charts show that we tend to trade lower. So what's changed in the last 5 years? Well, world stocks have worked down a little bit. And so, I think that we'll watch the Russian crop, certainly. We'll watch the EU crop. We'll watch the Australian crop. But for weather over there, and see which of these paths maybe we try to take. But the funds have bought back like they did in the other markets, bought back a lot of their short positions in Chicago wheat. They're short about 30,000 contracts as of today. Looking at the Kansas City chart, very similar to Chicago. We stalled out at the 200-day moving average. We had that reach the hot zone just briefly, and now we're back into neutral. Again, up around 619, probably be a seller. Around 576, the bottom of this with a 50-day moving average, probably want to sit on my hands and wait for a while. Looking at the funds have bought back most of their short in Kansas City wheat, now only short about 5,000 contracts as of last week. In Minneapolis, similar looking chart. We made a double top, it looks like, with the July high, and now we've backed off once again. So indicator lines are turning back down. I think I had this in the hot zone still on Friday, but kind of backing out of that, I think, here today. But again, you get back up around 6.5 or so, probably not a bad place to be selling some of this wheat. And the funds, they were short about 8,000 contracts on Friday, so they've bought back much of their short position here as well. So where, 2 or 3 months ago, we were looking at these massive short positions that the funds had as opportunities. I think that if they bought that back, it would give us a rally to sell. I think we kind of saw that, but it happened real quick, and now we've kind of moved to the sideline again. Looking ahead to next year, where are we at? Well, one of the objectives that I always have in marketing is to try to top the insurance price. Because if I buy revenue insurance and I buy a revenue guarantee based on that number, then if I have a chance to market above it, essentially I'm raising my revenue guarantee for the farm, which is a good goal of mine. If it made sense to buy revenue insurance here, then selling up here is an even better deal. And so that's what's happened. We've rallied this market from where we set the insurance price on both Chicago and Kansas City wheat. And I think it's given us a good opportunity to be able to do some hedging here. This market hasn't fallen back quite like the nearby markets have. So I don't think it's a bad place to be triggering a little sale for next year. Both Chicago and Kansas City trade around 638, 639. I think I would want to have a little bit on the books here for next year. And if we trade lower, then I'll sit and wait. We rally again, look to be pricing a little bit more up around the 6.5 mark. Finally, cotton. USDA made one huge adjustment. That was lowering the cotton yield once again to 789 pounds, lowest we've been since back in 2015. If you look and see where that was at, that was all in the southeast due to the hurricanes that had gone through. Helene certainly raised its path through Georgia, South Carolina, North Carolina, Tennessee, Alabama, Florida, did some damage to the cotton crop there. And I'm sure that that was the driver in the adjustments USDA made here last Friday. Took the crop down to 14.2 million bales, even below where we were back in 22 and 2020. So 2 years in a row, not huge cotton crops. And that number, even though we don't have a lot of estimates from analysts, that was at the bottom of the range of the few that put out their numbers. So should have been a little bit friendly, you would have thought, to the cotton market when we got that report on Friday, that they took production down to 15.2 or 14.2 million bales. Problem continues to be demand, and USDA cut the domestic usage, cut exports. So ending stocks actually went up to 4.1 million bales, despite the drop in production. And that's pretty sad for the longs, anybody that's long cotton right now. We've been hoping and praying for some kind of upside to this market, but we're just not finding it. And so U.S. stock situation going to rise this year. The world stock situation expected to rise as well. The big story continues to be China. And we did get some friendly news out of China here the last month. We'll hit on that here in a minute. But China's been dealing with deflation in that country. And they did not bounce back following COVID. They didn't take some of the actions that our government did, pumping a lot of money into the pipeline. But they've been having a difficult time getting back going. Now, this story came out on Friday. The Chinese finance minister hinting at increasing the deficit at a highly anticipated briefing. They're talking about wanting to ramp up more government subsidy, ramp up government spending to try to get their economy ramped up. And that has been a little bit friendly to the cotton market, but it hasn't been sustained because we're just not seeing it show up in their economic numbers. And so the funds have bought back a chunk of their short position, again, driven by this Chinese stimulus. But what's it going to do? We're still not seeing China come to the market. And so that stimulus buying from the funds, they rallied cotton 8 cents off the low. And now here we are just kind of waiting for it to happen. Like the other markets, I did have cotton in the hot zone for several days. But once the stochastics turned over, we've taken it back out. It's back into neutral, actually pushing down towards the bottom of the zone. So I don't want to be a seller today. I think this 74, 75 cent window is probably going to be what we can expect I've read a couple other cotton analysts suggesting 74, 75 makes sense as a hedger. Not where we want it to be, but if you've got to sell some cotton, probably the decent place to be. If you had stacks insurance this year, we are down on price right now, 12% from where the base price was. So at that high level, 90%, depending on where your county yields are, we could see some stacks payments. I would assume in the Southeast, especially this year, we're going to see a lot of stacks payments made. In the Carolinas, Georgia, depending on what your county yields end up. So something to keep an eye on there. So looking ahead to next year, kind of hard to be excited at this point at 73-cent cotton. I do think up at the 200-day moving average at 75 probably makes sense to be a hedger there, get started. But 73 cents, I don't think we're going to add acres next year at this point in time. So a quick update on the government program numbers. USDA didn't change this year's prices. In the report on Friday, 410 is the average farm price on corn, 1080 beans, 570 wheat, seed cotton still 66 cents. What does that mean? Well, for the ARC program, these were the benchmark prices. So for a crop like corn, it's possible we could still see some ARC program payments this year, depending on what your county yields look like. Otherwise, in most other crops, I don't think we've seen a big enough drop in beans or wheat to trigger any ARC payments this year. For PLC, you'd have to be down below these numbers in the blue box. Corn's not very far from it, but I don't think we're going to probably get there as the average for the year. Sorghum kind of close as well. So we'll kind of keep an eye on that. Rice just above a little bit. Peanuts are below. So, I would anticipate there's a decent chance we could get a rice and a peanut payment on PLC this year. Looking ahead to next year, again, we'll talk more about this through the winter. But I'm suggesting that the ARC program at the FSA office is going to look pretty attractive going forward. Why is that? Well, if you look at the price for ARC at 506, the bean price at 1220, these are the current futures prices for new crop futures as of Friday night's close. And so if you were to compare to, say, SCO, which ARC and SCO are very similar at 86% county triggers, then ARC's going to have a big advantage on both corn and soybeans. A little bit on wheat, maybe on cotton, maybe not. I still like the stacks policy there versus doing the ARC program. Sorghum, ARC's going to have a big advantage. Barley. So feed grains definitely are going to migrate towards the ARC program. Now, that only matters if you have base of those acres. You got to have a base to be able to get a payment. So remember, those payments are made on base acres, not on what you plant. So if you're going to plant a bunch of corn or barley and you don't have any base acres, then you might want to consider SCO coverage to get that 86% down to where your individual coverage is at. So we'll talk more about that in the months ahead as we get closer to making that decision. So updates on crop insurance. We're almost halfway through the month of October. These are the averages right now for revenue insurance for the majority of our states. Some of the southern states set their prices back in September, but you can see that the majority of the corn down 9%, sorghum down 8.8, beans down 10.7. So depending on your coverages, we may trigger some payments. Same with cotton. We may see some stacks payments because we're down 11, 12% on price. And as it sits today, these prices are now trending below the average. So probably going to pull this average down a little bit between now and the end of the month for some of these markets. So what's it mean for something like ECO? Well, this is our ECO indemnity worksheet. And so I want to show you an example with the prices currently where they're at. And if I negate yield at this point, because I don't know where county yields are at, some of you are going to be seeing some really good county yields above average. Some of you may have counties that are under their expected county yields. But based on where we're sitting today, just on price alone, we're looking at about a 4% drop in revenue because we're from 466 down to 424. And so 44% of this 9% band would equate to a payment in SCO or ECO of about $37 an acre. If your expected county yield is higher than or if your final yield's higher than the expected county yield, that's going to eat into this $37. If your county yield's at 190 instead of 200, this payment's going to be higher. So, but because of price alone, we would expect it to get half of that band as of today. In soybeans, it's a little bit bigger because we're down a bigger percentage. And in fact, you do the math, we're down about 5.6% below the 95. And so, which means we're down 10.6% on price. And so we're going to be collecting a little over half of that band as of today, assuming that the county yield was unchanged. So again, county yield's going to matter a lot, but price is part of the reason that we bought ECO this past year. And because of the drop in the prices, it looks like we could see some payments at a lot of counties this year. In margin protection insurance, we've got a bigger drop in price because we started much higher, because we started at 509 in corn and 1295 in beans, 805 in spring wheat. You can see the percentages that we're down right now. And those numbers are probably going to get a little bigger if this average continues to come down. So at 95% coverage, we would expect to see a lot of payments on margin protection driven by the drop in the price. And so I would encourage you, if you've got margin protection policies, pull up the indemnity worksheet and matrix that we've got available. Make sure that the numbers are updated over here, that the price numbers are up to date. These are here. But if I assume an average yield in my county, and then the other thing that comes into play here is this protection factor, because if once we start to trigger payments, if you've got the protection factor at 120, for every dollar loss in the county, you're going to get paid $1.20. And so as of Friday night's close, we would be triggering an indemnity of $127 with margin protection just based on price drop alone. And that includes the adjustments in the input prices as well. Again, if your county yields are higher, then that number is not going to be as big. And we've got the matrix underneath this where you can look and see, okay, well, if my county yields at 210, comes in 5% higher, at wherever we're at, down to 428, roughly, we're going to be a little bit below that. Now you're $66 an acre. And I can adjust these percentages, which will adjust the prices if I want to narrow in this price range to show what I want to show. And soybeans, it's bigger because we're down substantially on price. We're looking at $165 an acre right now, trigger on beans. And, even if my county yield comes in at 5% or 10% above, we're still down here in the low tens. We're still looking at just, $75 an acre with a 10% higher yield. So, point is, these policies are working. They're doing what we bought them for. They're protecting because of the drop in the price. Now, once October is over, that coverage is over. And so keep that in mind. And that's why I like this min-max strategy to continue your price protection to the downside in case these markets continue to work lower. Looking ahead to 2025, here's what corn price looks like right now. We're at 450 basically this morning. What's that mean to me? Can I make money at 450 corn? Well, what do I want to do to protect it? Do I want to be making sales? Do I want to be buying insurance? The margin protection policy is behind us now. So what am I looking at going forward? Do I want to utilize a product like our Power to lock in this price for next year for my revenue insurance? Those are all things that I have to ask myself. But I want to show this tool that we've got, this producer profitability matrix, because I really think this tool is going to be something you want to use this year. If you're an agent on the call, check it out. If you're a farmer on the call, ask your agent about it. But this is going to be able to incorporate really all of your key pieces of revenue for the year and then show you how that plan is going to be able to play out for you. And so this initial picture that you're looking at today, I ran this using Champaign County numbers. Champaign County, I used a 230 individual APH. The expected county yield for next year is at 227.7. On Thursday, when I did this, the December 25 corn was at 454. And this chart shows no insurance. Didn't buy revenue insurance, didn't buy SCO, ECO. I used $1,086 for my corn expenses, which I realize is a big number. That's what FarmDoc published here about a week and a half ago for Central Illinois. That's their number. That's not your number. Every farmer is going to be different. I would encourage you to plug in your numbers. Hopefully, they're not $1,086 an acre. If your numbers are lower, then that's great. Your chart's going to look a little better. The green down here is where we put forward sales. And as of today, I put in 0 there as well. And so the matrix is going to show me 200 plus examples of price and yield and profitability. And you can see we've got, it looks like a challenge ahead of us this year. We've got some lot of red on the screen here, a lot more red than green. So if my expenses are $1,086, again, I've got some challenges. Either I've got to raise a great yield, have price go up to make money, or I need to protect myself for the downside. And so the first thing I might look at is buying an 85% RP policy. What that does is essentially stops the bleeding. It gets rid of these $400 and $500 losses, and it stops it at negative 223. And again, assuming that my costs are $1,086. If I'm $100 less, then all these numbers in the matrix are going to be $100 better. But that 85% policy isn't going to guarantee me profitability. What if I do something different? What if I do 80% RP and buy SCO, which then is a little cheaper, but I've replaced some individual coverage with county coverage from 80 to 86%. And so gives me a little bit more bang for my buck. And it lowers my worst case scenario, still doesn't turn many more boxes green. The other thing producers might want to do in corn this year, we talked about it a minute ago, is look at the ARC program. So maybe you don't buy SCO, you sign up for ARC instead. And that gives you some extra coverage from 86 down, or roughly about a 10% band of protection there. What if I decide that ECO makes a lot of sense? I want to get up to that 95% trigger because I need that 95% coverage to cover my cost of production or to get close if I can. And so even by adding the extra premium, now one thing about ECO this year, we're going to see a subsidy increase. The subsidy is going to go up 21 points to 65%, which is going to make ECO much more attractive than it's been in the past. And so if I do 80% RP, SCO up to 86, ECO to 95, then even bumping my premium, and this is just an estimate at this point, but I've made my worst case scenario better. It's still not in the green. And again, if my expenses, say I'm $100 less, now, I've gotten a lot of these numbers back closer to 0. So at least I'm limiting my exposure to the downside. If the markets rally, I want to take advantage and make some sales. And so I said in here, what if I sold 75 bushel an acre today at 454? Well, depends what the market does. If we go down, that looks like a good deal. If we stay where we're at, didn't help me. If we go up, it's not as good a deal, of course, by having something sold ahead of time. So, but if we rally corn, let's say we get to 460, 470, maybe I want to trickle off some sales and start locking some in. So it's early. It's only October, but it's not too early to be thinking about next year and to be putting a plan together and have your marketing strategy to where I'm going to start selling some of these bushels going forward. Start thinking about what my coverage wants to look like for next year. Does SCO make sense, or should I do the ARC program instead? Spend that extra money on ECO, get my extra coverage up at the top end like this, and we can help put you a plan together. And I don't know how rosy it's going to be. It depends on your situation, depends on your input costs. But I do think that this tool is going to be very valuable this year to be able to help producers see a picture of what their plan looks like. And so I invite everyone to check it out. It's on our agent portal. It's under our resources tab. You can go to our indemnity worksheets. It's in there, and check this out. So what's coming up? Really nothing more the rest of this month. We will have our next USDA report on November the 8th. The 11th, on the following Monday, I'll be hosting the aftermath webinar again. We'll have our Thanksgiving on the 28th. Markets will be closed that day. The deadline for PRF, pasture, rangeland, and forage, for next year is December 1st. So be thinking about that as well. The 8th of December, we have our next report. We'll have our next aftermath on the 11th, and then Christmas, of course, on the 25th. So where the markets will be closed. So with that, I don't see any other questions. Again, I want to invite everyone, if you don't subscribe, you're not getting the opening bell phone call in the morning or the market report in the afternoon, let us know. If you're an agent, you want to get your farmers signed up, let us know. We'll be glad to add them. We have this aftermath webinar. We do the thinking cap videos occasionally as well. Did one last week. So, check those out as well. we've just got a lot of ways to get information out to our growers, and we want to help you guys be profitable. So thanks for tuning in to this month's Aftermath, and we'll visit with you again in the near future. Thanks a lot.